All right. Hello, everyone, and welcome to this week's edition of the Dividend Power Hour. It's always great to be with you. As always, if you're a regular, you already know what to do, and I already see some of the comments in there. Let me know, where are you tuning in from, and what stocks did you buy this week? We had kind of a wild week so far. New all-time highs we've reached here in the S&P 500, and we had a return of the meme craze. Roaring Kitty is back, or apparently made a few tweets, so that was enough for the whole Wall Street bets community to get back into the stock trading game. I made a little dough on some AMC trades, jumped in. Just a quick little, to tell you a quick little story of how it went. I saw this whole thing come about, and once I saw it, I jumped into AMC, bought a few call options with a $5 strike price. At the time, AMC was trading right around $4.80, I want to say, is when I entered the trade. So not much in terms to reach the call strike price that I had. Went into it overnight, so I held on to it for the end of the hour that particular day. Started my workout in the morning, and those of you that are part of my Discord community, you already know this story, so it's nothing new to you guys. Started working around 6:30, right when the market was open Pacific time here. Got into my warm-up and looked at, boom, AMC was up 98%. Had to take a break from the workout, close out of that trade, made a couple grand on it really quickly. So that was my quick story and some enjoyment on taking part in the meme craze. By the end of the day, the stock was only up about 20%. So cashed in pretty much at the peak there, which was always fun to do. So, all right. So if you're just joining us, folks, let me know, where are you tuning in from? And did you make any buys this week? Buys or sells to the portfolio? We got Jeff in the house, Minneapolis, bought some PLD, can't stay away. Can't stay, so we'll watch the replay. Thanks for jumping in real quick there, Jeff. Thoughts on Chubb now with the big news. That'll be interesting to definitely take a look at. King David, some people think we're in a recession. He thinks that dividend stocks would be best for protection along with an emergency fund to help ease any volatility. Number one, we should always have an emergency fund, about a 6-month emergency fund that's usually not invested in the stock market, is usually the advice that I give to family and friends that ask me that particular question there, because we want something that's easily accessible at a moment's notice, usually during an emergency. And hopefully none of us have those, but we always want to be safe and be ready to go when something like that strikes there. So based on that, however, whether we're in a recession or not, dividend investing is a route to go. It's one that I'm a big believer in. Why? I like the idea of passive income. I like the idea of the power of compounding. Dividend investing is not just about the dividend income. In fact, I rarely look for the income necessarily. I look for the dividend growth. Obviously, I want the income to come in because that's going to help me build my share count when I'm reinvesting. However, I'm not so fixated on yield as much as I am fixated on dividend growth, because companies that show me their ability to increase their dividend year in and year out at a high rate of speed are usually companies that are growing their free cash flow at a good rate too. Because if the dividend is taking up too much of our free cash flow, probably not a stock we want to look at too closely, because that's probably a dividend that's going to be cut. And that's probably a company that's starting to slow down in terms of growth there. So something to definitely keep in mind there. Sean Wong from Singapore, tempted to buy some HD after earnings. We'll definitely take a look at some Home Depot stock today. A favorite of mine, although I don't own any right now. No Home Depot stock in the portfolio right now. Kind of just waiting it out to see where this consumer in the U.S. or globally kind of goes here. But we'll be following the 3-day rule. No buys this week. That's a good rule of thumb. And for those of you unaware, what Sean's talking about is anytime you get a big move, a big news event, a big move in the stock. We saw it with Meta. We've seen it with Starbucks. Usually you want to wait about 3 days because there could be another leg lower in terms of just letting things wash out and settle down in terms of volume trading, because it gets a little bit volatile those first few days after a big event like an earnings call or anything like that. Michael, good to see you. Hi, Mark, from the big island of Hawaii. Ethan, thanks for tuning in. Be heading to Hawaii here. When are we going? Sometime in June, I believe, for a little summer vacation. Always like to go out to Maui, one of my favorite places to visit. I've been kind of all around the world, over to Europe, not everywhere around the world. Still haven't been to Asia. Australia is on the list to go visit. But Hawaii is just a place that I love to go visit, particularly Maui there. So if any of you guys are out there in Maui, maybe we'll be doing a dividend power hour from Maui. Most likely we will be. Speaking of Australia, Andre, there we go. We'll have to all go visit Andre. Anid, good to see you. Hello. Illinois in the house with Kevin. Matthew, good to see you, my friend. Skippy, tuning in from Western New York. Jeffrey Hatch, good to see you. Washington nibbled at some Disney and bought some VIG. Love it. I love the VIG right now. Teresa, good to see you. Argentina's in the house. Mariano, thanks for tuning in, Mariano. Cindy, St. Louis. Oh, Cindy went REIT shopping, nibbled at some Realty Income, some Agree Realty, and Vici. 3 REITs I like a lot, especially those last 2 there. Jim Betts, as always, thanks for tuning in from Nebraska. King David, IBM looks like a good buy. We got some news on IBM. Not sure if you saw that today. Kevin slips in quietly from Washington. Wisconsin's in the house. Scott, good to see you. John Bircher, good to see you, my friend. Google and Amazon. Amazon was a purchase of mine this week, and John knows that because he subscribes to the Stock Investor's Edge. And for those of you that aren't invested, I have a free newsletter that's out there, completely free. You can get an update, a midweek update for the free version. However, if you want access to my entire portfolio, as well as my good friend Chris, we both put our portfolios up there. Stocks we're buying, stocks we're selling. You get research reports that we put out each and every week, top stocks to buy. If you want to be an Edge Plus member, check out the link below. At least just sign up for the free one and get the information to stay up what's going on in the market. So good to see you there, John. Carl in Tennessee, good to see you, Carl. Bought some SPLG, some Vici and Fenny. Not sure what that one is, so I'll have to double check. Chuck, the Canadian, I got some USD and some SMH. What are we buying here, Kevin? Vici, PLD, and Agree Realty. Some more REIT shopping. Love it. All right, Skippy, we bought Vici, another REIT. Then we bought some AbbVie and a few more sips of Starbucks. New Jersey's in the house. Good to see you, Tom. Back-to-back New Jersey with JC. Jim bought some MFC, some Pfizer, and some ADC this week. Looking at NEE and LYB for the remainder of the week. Jim's on a buying spree. Love it. Completed my minimum position of Bristol Myers. Nibbled at other positions. I actually went the other route, and you know, there's no issue with adding Bristol Myers here. And when you look at the stock chart, not that great to look at. When you look at the valuation, very cheap. But it's one of those stocks I'm looking at right now that I've held for quite some time that I'm just like, it's not doing anything for me. And I don't see the catalyst higher. There is, you know, a decent pipeline that they have. I just feel like they need to go out and make an acquisition to kind of reignite that growth moving forward. So in terms of evaluation, from a long-term perspective, great valuation right here, but it's one of those stocks, again, that I believe is cheap for a reason. What is the reason why it's going to get higher? That's what I can't tell as an investor right now, and that's why I actually dropped the stock recently. So I just felt that, hey, it's cheap, but I feel like I can use that money elsewhere. Part of that money went towards Agree Realty. Part of that money went towards Amazon. All right, Ron, upstate New York, no buys this week. Back again from Alaska, bought 1 GameStop, jumping in on the meme craze. What do we got? Bought some Toast and some QQQM. For those of you that don't know, there's 2 types, QQQ and QQQM is the little sibling to the triple Qs there. Pretty much the exact same thing, lower expense fee. However, if you are interested in options or you do trade stock options, QQQ is the route that you want to go. Much more in terms of liquidity, and a lot of contracts are traded on a regular basis there. All right, Carl's going to tell us what Fenny is, a cheaper version of XLE. All right, so an energy play there for Carl. Kenny bought some SPY and some SCHG, a little bit of growth exposure there. Sold some Apple and bought some Realty Income and some VYM for Carolina. Is it Castles? All right, King David also bought some Jeppy and some Hershey's, so high yield with Jeppy, and then some Hershey's. Great valuation that you're getting on Hershey's. Of course, we've already talked about it a number of times, is there's a lot of headwinds with those cocoa prices. You know, I just went, my wife's been craving this certain dark chocolate bar that I go and get, and I can get it at Target, usually $2. Today it was over $4. So that right there, you can kind of see the inflation just in a small example, but that's the impact that those higher cocoa prices are having. Hello, Holding Cash, Bloodbath, QW, and 3. What do we mean there, Slim? Q3? Bought some SCHD, some BMY, some Visa, and some Starbucks. Do you see your favorite stock, MPW, as well? MPW, yeah, it's still in penny stock territory there. So Hopefully it builds up. That is one of my favorites. Not really. I have some amount to invest for 1 year period. Is it better to buy REIT or invest in a CD for 4.5% yield? Well, there's a number of different things that you want to look at right there. Number one, the CD is going to hopefully be a locked in fixed rate there at 4.5%. Not sure how long of a long dated REIT that you're looking at in terms of a period of time, because you're going to be, locked into that. And number two, and ask yourself, if you do have a long period of time, is 4.5% what you want? Again, the S&P 500 over the past, 5 decades usually grows between 8 and 10%. That there alone. Now, if you're looking at REITs are very cheap right now. Again, very similar to what I was talking about with BMY. Cheap for a reason. They're very interest rate sensitive. And we've talked about it, over a number of weeks on this Dividend Power Hour. So I don't need to beat a dead horse here. But the fact of the matter is REITs have very high interest rates, or very high dividend yields, excuse me. But right now, with high interest rates, people also see high yields on high yield savings accounts or CDs. You're talking about right there, 4.5%. So risk-free 4.5% over here. Why invest in a REIT to get 6% and possibly lose 20% of my investment, which has been what Realty Income has done, and all of those REITs. Name a REIT and they've largely come down, except for the likes of DLR or things like that, data center REITs, which have performed quite well from that standpoint there. However, now we're in this low valuation, and what's on the horizon? Interest rate cuts. And when interest rate cuts, that's going to relieve a lot of pressure from the likes of the REIT industry. So now those investors that had the 5% high yield savings account, the 4.5% CD, the new rates are going to be 2.5%, 3% in the future. Now you're looking at a Vici, you're looking at a PLD, you're looking at a Realty Income and Agree Realty that have a 5-6% dividend yield and upside potential. You're buying at a cheap price, you're getting a great dividend yield, and you have upside potential. That's why I continue to refer to this period as the accumulation period. Again, there's no immediate catalyst higher, but there is a long-term catalyst higher, and that's going to be by the way of lower interest rates. So something to think about from that standpoint. Are we talking long-term? Is this something where you're buying a 6-month, a 3-month CD? So you'll have to kind of ask yourself those types of questions from that standpoint there. And you're coming in from Fort Worth, Texas. So thanks for that question, Shiva. All right, what else we got there? Cocoa prices also affect Starbucks. Good point there, Teresa. There we go. So Slim was referring to Q2 and Q3. We could have some tough times ahead. Greetings from Peru. Nice. We love a green day. John Silva, good to see you, my friend. Hope all is well. Lloyd, is Starbucks really a good buy even at this level? And it kind of continues on the theme we've been talking about here, whether we've been talking about BMW, whether we've been talking about Hershey's, whether we've been talking about Starbucks. I think Starbucks and Hershey's are two great examples. Near-term headwinds, long-term solid execution. Right now, there's questions about this management team. Brand new management team in here. Even the old CEO came in and kind of battered the current management team that's here. Not sure why that was necessary. Not sure why he believed, and I'm referring to Howard Schultz. Not sure why he believed that was going to be a good thing, but he did it anyway. So there are some question marks around the current environment of the Starbucks management team. Starbucks is a proven product. Starbucks has a big time showing. Just look at their active members. Even in a down traffic time, membership continued to go up there. I mean, this is a very loyal group. Around me here, if I go in at the wrong time when high school's getting out, my Starbucks order could take 25 plus minutes from that standpoint. That's me ordering it 10 minutes ahead of time, getting to the store and waiting 25 minutes. I was late to a coaching session that I had because I was just waiting for a simple cold brew. All I had to do is pull the lever, fill it up, light ice, and let's get to work and move on. Nope. That took a while there because there was a bunch of fruity drinks. They still love the product overall. There is a consumer, though, a piece of the consumer, we're going to talk about it more today, that's pushing back on the price hikes. $6 drinks are kind of tough. $7 drinks for even some of them if you're getting the large size. And I refuse to use those other terms that Starbucks does, but I go small, medium, large. Irving, Texas is in the house. Good to see you. Man, we are an active group today, and I love it. We haven't even jumped into the show yet. And look at this. We're 14 minutes in, and we got questions up the glue here, and I love it. I don't even know what glue means, but all right. Which is the better buy? Realty Income or Agree Realty? So good question here, Carl. I know you and I have looked at the valuation aspects as Carl came through the 6-week course. And when we were looking at the different AFFO requirements and we were looking at pricing, Realty Income typically trades at a higher multiple. It has proven itself. It has a great management team. However, when you look at the growth is slowing. And when you look at Agree Realty, built very eerily similar to the likes of Realty Income. Differences are is when you look at the top tenants. And when I look at Realty Income and I see Walgreens and I see Dollar General or CVS, doesn't excite me that much. Although I still have Realty Income. I haven't sold any. Also haven't added too much. But when I look at Agree Realty, and I know John Silva is going to love this, I see Walmart. I see Tractor Supply Company. Those two companies excite me a whole heck of a lot more than the likes of Walgreens and CVS and Dollar General and Family Dollar and things like that. So from that standpoint, and it's much higher exposure, there's a lot more growth opportunity when it comes to the like of Agree Realty, I believe, at least in the next 5 or so years from that aspect. So that's why I've been adding to my position in Agree Realty. And again, it's the accumulation phase where if I have some extra money around, I'm going to be adding to the likes of Agree Realty. And we're going to take a deeper dive into one of these REITs, potentially Agree Realty. For those of you that are Edge Plus members, each and every week, I'll mention it again, for those of you that have just joined, we have a free newsletter, the Stock Investors Edge, but we also have a part of a membership that's the Edge Plus, where you get to see full access to my portfolio, all the stocks I'm buying, all the stocks I'm selling. There's actually multiple portfolios in there. We do a top stocks to watch list each and every month. We do a deep dive every single week. So that next stock that we're going to be looking at could potentially, wink, wink, be a REIT. So we're going to go through all the different metrics we're looking at to determine, is this stock a buy, sell, or hold based on our opinion and our opinion alone. So definitely there's a link down in the description below for the Stock Investors Edge. We would love to have you. We have a Discord community. That's the fastest and easiest way to contact both myself as well as my team. And we have a growing community in that Discord. So it's a great spot to check out there. So hopefully that helps answer to a degree, Carl, your question when it comes to those REITs there. John loves his REITs. Oh, and CTRE. Ryan, what's up, Mark? I've been throwing some money at Google. Here we go. Google, what we hit? New all-time high today. So as you guys know, it's my largest individual stock holding in my portfolio, as we've mentioned a number of times here. So awesome. I love the questions here that you guys got going today. Let's jump into some updates to see where is the market at. So we're going to jump over to our to the iPad here and see what is going on. So as you can see here, let's take a look at the S&P 500. So we'll just use the SPY as an example right now to see where the S&P 500 is, which is sitting at we touched 5308 is our new 52-week high. As you can see there on the iPad, we are up 26% over the past year. And if we look at the year-to-date stats, we are up about 11.5% overall when it comes to SPY. Let's take a look at the NASDAQ, and we'll just look closely at the NASDAQ 100. So let's just look at the triple Qs to see where things are at. We're kind of going to go off topic a little bit more, and folks have been messaging me, especially in the Discord and stuff like that they like me going to the iPad and just kind of going off topic from that standpoint. So that's what we're going to try to do today. So you guys give me feedback if this format is what you guys like here on the live show here. But here's the triple Qs. You can see we're up almost 40% over the past 12 months. Year to date, we are up 10.59%. And I mentioned it earlier, but I'll just show you while I'm here right now. Again, expense fees are what we want to be mindful of when investing in ETFs. And if we look at triple Qs, we could see the expense fee there, 0.2%. And if we look at the number of holdings, or the top holdings, I should say, we go here, we see technology is the largest holding or the largest sector, but the largest holdings individual are Microsoft, Apple, Nvidia, Amazon, and Meta, followed by Broadcom. And now let's go over to the little sibling one that I mentioned to you, which is QQQM. Here we go. We have technology as the largest individual holdings, Microsoft, Apple, Nvidia, Amazon, Meta, and then Broadcom again. So pretty much exactly the same. Main difference, if we go back to the summary page here, what is the expense ratio? As you can see, 0.15%. So you save a little money. And for those of you unaware, expense fees are what is paid and reduced from your investment in that particular ETF. That's how these brokerages make their money. So that's what we're looking at there in terms of where we're at. Let's take a look at sector performance. So we look at this one each and every week. Here's a look at where we're at in terms of sector performance. Let's look at year to date. We could see at the top still communication services, followed by info tech, then utilities, energy, and financials. Those are the 5 sectors that are outpacing the S&P 500 right now, which is right at 10% overall. The laggards, still sadly REITs, but that's why it's the accumulation phase. For those of you that are long-term investors, now is the time to start accumulating shares, because I believe, and I've mentioned it, a number of times here, that I think once we get out 24 months from now, we're going to look back on this period and say, I wish I bought more ADC. I wish I bought more PLD. I wish I bought more Vici and things like that. No guarantee. Again, my magic 8 ball stopped working years ago from that standpoint. But I just, believe, based on the valuation you're getting, the upside potential, as long as we don't go into some deep recession that is unforeseen right now, I think that's what's going to be the case when it comes to the REIT sector. So as a value hunter, I'm less looking at the top performing sectors. Doesn't mean I ignore them, but I'm more looking at, okay, what's underperforming? Where are we at in the economic cycle? And for those of you that have come through my 6-week course, you know exactly the image that I'm talking about. The stock market goes through a number of different cycles, and different sectors work during different cycles. The stock market is forward-looking, less about what you've done for me, more about what you're going to do for me. And there's a separation between the stock market and the economy. So again, we've talked about the Stock Investor's Edge. We've talked about, a lot of this valuation stuff. If you're interested, and you want to become your own money manager, your own portfolio manager, and learn how to value stocks and construct your portfolio the right way, definitely check out my 6-week course. We have enrollment open, just a few spots right now of students that just recently graduated. There's a link down in the description below where you can get a free evaluation where we talk a little bit more about the course and just see if you're a good fit first and foremost. Everyone that comes through that books a call, some of them aren't necessarily a good fit from that standpoint. And we just want to be realistic and an open book from that standpoint. So if you are interested in that 6-week program, we do have 2 spots that just recently opened up or will be opening up at the end of this week. So you can get a call on the calendar. There's a link down there below, as well as a link to our Stock Investor's Edge newsletter that you could be signing up for. So let's jump back here to the iPad and take a look at our sector performance for the past 3 months now. So this gives us a better indication, past 3 months and the past month here, on what's going on. So what are, similar to what we've talked about last week, some more defensive sectors, things like utilities, things like energy, and things like what else? Consumer staples would be one, which is going to be, it's still outperforming, but you see utilities, and that's an interesting one. So if we go back to Seeking Alpha here, and I just caught this one on when I was on a call with a student going through a course today. Praveen, if you're watching, hello. I know we were talking about this. Let's look at the XLU. The XLU is the Select Sector Spider Utilities ETF. So again, utilities is another very rate sensitive sector, and very defensive sector at that too. A lot of people, why do they invest in utilities? Usually for the dividend income. So from that aspect there, if you were going to go and you were looking at, hey, things are going to get slower, we could see a pullback in some higher growth stocks, some faster, more volatile stocks from that standpoint, where are you going to move your money? You want to move it to safer. We typically don't want to just take our money out completely, because again, I'm a big proponent of time in the market over trying to time the market from that aspect. But utilities is typically a very defensive sector. So when we're looking here at the XLU, what is something interesting that you see right here? XLU is trading at 72. Reset that zoom there. 72.53. Where are we trading on the XLU? Look at that. We are at a 52-week high. Very interesting when you look at that. A very defensive sector. If we think the economy is great, why are people flooding into XLU? Why are people flooding? I mean, it was hit hard. So if you want to zoom out a little bit further during the pandemic and all that stuff, yes, XLU and utilities in general were hit hard. But the fact of the matter is we're sitting at a 52-week high. So what is the high point right there? Back in September of 2022, right around $75, $80 between that mark right there. We're within striking range of that right now. So that gives you some concerns. S&P 500 is sitting at an all-time high. However, a lot of money is going into XLU and utilities in general. Does that make you think a little bit more as an investor? Okay, that's just one area. How about we revert over to the consumer? We've seen it with Starbucks. And We've seen consumers pushing back on high prices, lower traffic. We've seen it with the likes of McDonald's, lower income consumers pushing back. Like they're looking for value. When you think of low cost to go get a quick bite to eat, you probably think of McDonald's. They're getting some pushback. They're bringing out the new $5 meal or whatever it is. Let's see if I can find it. Where's the $5? I had it up, but I guess I don't anymore. They're coming out with a new $5. They're trying to spark some growth, getting traffic back. We saw it with Home Depot. What did they mention? Slower traffic, slower consumer spending. People aren't fixing their homes right now. They're thinking, hey, I've earned this money. I have what I work for each and every week, my 40 plus hours that I work. Do I necessarily need to go buy a $6 coffee? Do I necessarily need to go out to eat in general, or should I save a little bit? Prices have skyrocketed. I mean, you go to fast food. I went to coffee the other day. I have a family of 4, a 5-year-old. It was literally like $60 just to go out to a place like Kava where you walk up and they just scoop food into your bowl. Same thing with Chipotle. Prices are high. Consumers pushing back. They're thinking about it. It's not because they have an overabundance and they're just so much better with their money because everyone's taken the 6-week course through Mark Rusin, as though I wish they all did. No, it's because people are going, hey, my dollar doesn't go as far anymore. I need to be a little bit smarter about it from that standpoint. That should give you concerns as an investor right now in terms of where you're putting your money. The stock market will tell you one thing, all-time highs, but when you look underneath what's going on under the surface, I'm concerned. Consumers pushing back on not just one area. It's not just like Starbucks came out and they just had a bad report and everyone else had a good report. No, we've seen it from multiple different areas. We've seen the inflation starting to weigh on it. And this is what the Fed wants. This is the point of higher interest rates. It slows the economic activity overall from that standpoint there. So definitely very interesting to look at. So let's jump back here. So 3 months, we saw utility, energy, and at the bottom, everything's green in the last 3 months. Look at that. Even real estate. How about the past month? Utilities still at the top, 11% utilities in the past 30 days. Consumer staples, financials, 3 pretty safe sectors to invest in. Oh, let's add a 4th. How about healthcare? So now we have shrunk the box a little bit to see, let's see what investors are really doing here. Because all we talk about is Nvidia and Google at all-time highs, even though I want Google to keep going and Nvidia to keep going because I own both, and Microsoft and everything. It's fantastic. We still got to be a little bit more realistic to see what's going on under the surface. Well, when we look at this, it tells us kind of a different story, if you ask me. So at the past 1 month, defensive, slightly defensive. That can kind of go either way. I'll give you that one. Healthcare is pretty dang defensive. And there's real estate. Look at that. Our REITs are creeping up into the top 5 there. But there you go. 3 out of 4, or you can call it 4 out of 4 defensive sectors in the past 30 days are all outpacing the S&P 500. Pretty interesting there, if you ask me. And on the bottom half, we have technology only up 1.7. Communication services, kind of the higher flying ones there. Consumer discretionary. That should tell you a lot right there. Because maybe we don't need to go and buy that new car. Maybe we don't need to go buy that new wardrobe or that new purse or those new shoes. Take a look at Nike. Consumer discretionary. People are spending on what's necessary, staples. We need our lights on, utilities. We need to take care of our health, regardless of what the economy is doing. But we don't necessarily need that extra fill in the blank. There's wants and needs. Right now, the wants are starting to lose and the needs are starting to win from that standpoint. So you always want to be keeping up with the data and understanding, number one, how to read it from that aspect there. And then we can look at today. Look at that. Everything in green across the board. Pretty good day. Everyone hopefully made some money today when it came to the stock market. So definitely, something interesting to look at. So what do we have this week? CPI. That's what we're here to talk about, right? And let me zoom through the comments right now because I know I've been talking a lot. So let me zoom through them real fast just to make sure I didn't miss anything. Agree Realty, Vici jumped. Hey, Mark, looking hopeful with those CPI numbers. We're going to take a look at them right now, Victor. Ryan, Mike, Salvatore, SPG, best mall REIT that's out there. Michael, which REIT are you referring to there? Which REIT are you referring to? I love how much hate Apple is getting as it is approaching highs. It will always be the go-to stock in the market. I'd be a little bit careful with that comment there, because you can go back and look at our dividend power hour. There's differences when it comes to investing. You want to be able to differentiate a company from a stock price. Again, I love Apple. I'm sitting here doing a live show with you fine folks on a MacBook with an iPad, with an Apple Watch on my ear, holding an Apple iPhone. Plenty of Apple. I've given plenty of money to Apple in recent years. So love the company, love the products, top of the line. But you got to be able to differentiate a stock price from a company. I can love a company, but not necessarily love a stock price. And if you go back to past power hours, we talked about Apple as it approached $200 per share. That wasn't that intriguing at 34 times earnings. Shortly after that power hour, what happened to the stock? Fell below 160. There's a difference. There's got to be value when I'm jumping into a particular stock. I don't blindly just because of the name. I did a video, probably been about a month or two ago, on Costco. Costco way overvalued. Love Costco. I could spend an hour plus in Costco and get lost. It's kind of dangerous. I always put out tweets like, "What's the over under today on Costco? Over under $300." It's always take the over, especially if the whole family comes. Where we go for chicken and some fresh veggies and berries, and we walk out with new bathing suits and a whole new wardrobe. So Costco you can get lost in, or even who knows? But you get what I mean. Love Costco, don't love the stock price at 45 times. You're talking about a stock price, a stock valuation that's more expensive than Nvidia. Would you rather own Costco stock or Nvidia stock right now if I let you choose one of them and just said, hey, give it 12, 24 months. Which company do you think is going to grow more? I'd bet to say probably 90% of you folks in here would probably say, hey, if you gave me $100, I'm going to put it in Nvidia if I can only choose one of those two right there. Costco is trading at 45 times more expensive than the likes of Nvidia. You got to be able to differentiate those ones from a stock price from that standpoint. All right, Ron checking in from New Orleans. You are the best, Mark. Hopefully he's referring to me. Mine's with a K. I appreciate that. Mike said, what do you think about TMF? Is that the Motley Fool? If so, they are a sponsor on my videos. So that says enough there. All right, Jim. I see that 3M dividend got thrown into the wood chipper today. Dropped to 70 cents from $1.51. Lost its status as an aristocrat. Actually lost its status as a dividend king. So that came out, but today was apparently the day on the new one being paid out there. JC loves his utilities. Utility stocks or just utilities in general? I'm joking. All right, James. Walmart paid a dividend in April and is due to pay again May 28th. How does this happen? I thought it paid dividends quarterly. Well, let's take a look and see what are we referring to. So I'm going to go on the other side of the computer so you guys probably don't see the screen, and I'm just briefly looking right now so I can get the answer here. So let's go to Walmart dividend. Walmart dividend payout. How often does Walmart pay? I don't see anything on them paying one in May, but I'll have to look back at that one just so I don't waste any time here. Trevon, good to see you. Mark, do you think there is value in this spinoff of ONL? I haven't looked at that one yet in too much detail, so I'm not going to opine on it one way or the other. Don't want to refer you guys, but for me, I don't have any pure office REITs. The closest thing I get to an office REIT is going to be the likes of Alexandria, and that's one that's misrepresented as an office REIT. It's not really a traditional office REIT like some of these other ones here, but that's a ONL not one that I look at all that closely, especially when it's in penny stock status like it is from that standpoint there. So Jordan, good to see you. Looking to get into utilities. SO does look solid to me. SO is one of the namesake ones. I mean, Southern is a fantastic company from that standpoint there. Has had an insane run. Utility stocks typically don't run fast. These aren't your high flyers, but when you see a stock, and we could throw it up here on the iPad real fast just to show you guys kind of what we're looking at overall. But if we look at SO, which is going to be your stock ticker for the Southern company, you can see that typically the stock trades in that range of 75 to down to 65. Not a huge range over the past year. We can jump out over the past 5 years. Still not much overall in terms of range. It's kind of very slow growing. 5 years only up 47%. That's not much when you're looking at a particular stock. But you can kind of see it just trades in this range that it keeps going through. Whoops, that was a bad line there, but you can see it trades simply in that range. And then if we go back from 2023, it's just stuck in the same one. But looking back in the past year, let me delete this, get off that. You can see past year here, look at that run it's had. All the way down from about $67 per share up to now at nearly $80 per share. That's a huge run in terms of a move for a utility company sitting at a PE multiple near 20 times. That's an above market multiple, which is seems pretty pricey from that standpoint. This is a stock that typically trades a little bit closer. Let's see, what are we at? 19 times. So actually, it's not all that terrible. So it's probably fairly to slightly overvalued at this standpoint, but that's even after a massive move. So it was relatively cheap prior to the past month or so. So, all right, what else we got? Costco is my go-to cheap date. Hey, it's a club, right? It's a very not everyone can get into Costco, so good date spot there as long as we're actually not shopping. $1.50, right? $1.50 hot dog. Mark, can you explain what stock types would do better or worse when the Fed cuts rates? Yep. So I talked about that earlier. If you were here for that one, so REITs are very interest rate sensitive group. So we've had a lot of people that there's a core group of folks, investors that invest typically just for the income side of things as it comes to REITs. So they've moved a lot of their money away from the income in REITs and over to income in more safe investments like high yield savings accounts, like CDs, which we talked about earlier. But as those are going to be usually, especially the high yield savings, variable rates. They'll hold them for, steady for about 6-12 months, whatever their agreement is. But you can expect those to start getting cut after that period as the Fed starts to cut rates. Actually, my high yield savings did have a small tweak already, which kind of shows you where those banks and financial institutions are already starting to look and expect some rate cuts there. So, all right, what else we got? John said, Mark, I find Bros intriguing. Have you looked at them and their trending? Bros is they had a good stock report. So it was very different from the likes of Starbucks. And for those of you unaware, let's just bring it up right now on the iPad. So BROS, it's a great stock ticker, by the way. Dutch Bros, for those of you unaware of what company this is here. So Dutch Bros competitor, look at that, up 4% today. But as you can see, it was at around $26 and change per se just a few weeks ago after it reported earnings. Now we're sitting up at $37. So a massive move just in the past month, up 15% in the past month, up 6% just in the past 5 days alone. So a big move there from Bros. Very different stock report than the likes of Starbucks. However, Starbucks going to be a different consumer class from that standpoint. Dutch Bros, tons. I don't know if you guys have ever been to a Dutch Bros before, but a ton of full menu of high sugary drinks. So usually there's going to be a lot lower, not lower end, but younger age, I should say, consumer. That's who they're trying to appeal to from that standpoint. I mean, you can go get like a 4 or 5 shot drink and it's just normal on the menu. You want to go do that Starbucks, it's usually an off menu item from that standpoint there. So different consumer base, but a great report that they had from that standpoint there. And we could see, let's look at, I think this was the one that kind of tells us. There's a little picture of what Dutch Brothers looks like. But as you remember, bad traffic for Starbucks, weak same-store sales. Come over here to Dutch Bros, very different story. You look at 10% increase, 10% growth in same store sales from that standpoint there. And you could see the adjusted EBITDA up 120%. This is a very fast growing company, and they have some plans to continue to build out its footprint as well. So it was kind of a role reversal after we looked at Starbucks, but a kind of a different class from that standpoint. Not something I've looked into all too deeply, but something kept kind of keep an eye on there. But that's a good one there, John. Paul Costa. Oh, he's getting me started with MPW. They were a big dividend trap. It's a stock that I got rid of at the perfect time from that standpoint. Sometimes, when it comes to investing, it takes a little luck. And this is one that I foresaw the kind of the company withering away to a degree. Very bad management overall, got out of it. And so it was a little bit of luck in terms of timing, but also foreseeing and doing my due diligence and understanding how things work when it comes to seeing the decline in operating income and seeing the decline in just the overall performance, being overexposed to just a few subset of sectors from that standpoint. Hospitals are a necessity. They will likely always be a need. So it's not the asset class that they own or where they're what they're investing in. It's the lack of management and things like that, and being overexposed to a weaker tenant. So not a fan overall of MPW, let alone their dividend from that standpoint. So, all right, let's jump into CPI, because I know that's a big topic that we all wanted to touch on today. So let's jump into the CPI craze here. So CPI report came out today, showed inflation is easing to a degree. So when this report came out, we've had, 4 consecutive reports that where inflation was hotter than expected. We had the economists had their expectations. CPI was above and beyond those. Not a great report there from that standpoint. Today was the first time that we got one that we were like, okay, that's decent. Not a great report. It's not like inflation is slowing all that much, but it wasn't a hot report. And that's what I was worried about. I had some options on, for those of you that are part of the Discord, I had some options on for the downside there, just trying to protect assets from falling. We got the opposite there, and that's fine. That's the whole idea of the hedge. So CPI report came out, increase of 0.3%. So this is the April reading for those of you unaware. Inflation eased slightly, and that's what I was just talking about there. CPI increased year over year 3.4%, which is exactly what economists were expecting. Core inflation, though, and that's what you guys know that I like to look at, because that excludes highly volatile items like energy as well as food prices. Core inflation came in at 3.6%. So the lowest reading since April of 2021. So that was a good report there. And we could see, if we look at the graph where the readings had been on month over month, we're back in line to where we were with the January report there. So it was 2 hot ones in a row, but really it was ever since October, we were kind of increasing and moving up in the wrong direction. So that's where the surge, the expected surge coming forward, was worrying a lot of investors from that standpoint there. So I think this Dan North, this economist from Alliance, kind of said it best with his WNBA reference too. This is the first print in the month that wasn't hotter than expected. So there was a relief rally. That's what happened today. People were like, "Oh wow, thank goodness that this wasn't hot like it's been for 4 straight reports from that standpoint. Thank goodness. It wasn't great. It's not like it came under expectations. It came in line. So investors went, oh, thank goodness, let's buy. That's the kind of the definition as a relief rally. Doesn't really tell you much about the continuation piece of it, which I have concerns about. But he said it right here in the next sentence. This excitement is a little overdone. And then his basketball reference, for those of you that are kind of keeping track. This is not Caitlin Clark. She's exciting. This is not exciting there. So again, not a great report, but not a terrible report. I believe it was one-sided in terms of this relief rally. We'll see if there's continuation to that moving forward over the next week or two from that aspect. But it was an okay report overall. I do get questions, though, from you guys a lot on, okay, what is made up? What in the world is this CPI report? What is it made up of? What's in it? It's a calculation of spending costs as a consumer. The consumer makes up over 70% of entire GDP here in the US. So it's the main component. There's a bunch of subcomponents that go into the calculation of CPI. Number one, being the largest, is shelter. So think of rent and all of that stuff. That's going to be the largest individual sub piece there. And you could see shelter 32%. We've seen rents start to kind of flatten out, if not come down. One reason you don't hear me often talk about apartment REITs right now. Not something I'm all that excited about. Although REITs are undervalued, that's probably not a subsector I'm looking at all that closely. There's some great ones out there, not one I'm looking at all that closely. What are some other large ones? Well, food and energy, but as you know, those are excluded from the core CPI, which is what I focus on, because you could have oil prices that are going to be extremely volatile, gas prices will increase a ton, so on and so forth. So this is kind of the weighting in terms of how CPI is calculated. So let's look and see how these ones did. And we can go over to, let's go to our newsletter. So this is the type of stuff that you're going to get. This is the midweek recap. So this is for the free. Everyone that signed up to the Stock Investors Edge, which there's a link down in the description below, you can just sign up for our free newsletter, and you're going to get information to keep you up to date with some key reports and things that are going on. We talked a little bit about the meme craze and things like that. So let's take a look at inflation. So this was an image, a visual that we put together that shows you those different subsectors that we just looked at here. So we can see fuel and oil down 0.8%. Utilities were down 1.9% from that standpoint year over year. Gasoline was up 1 point. How about electricity up 5%? That was a big one. Transportation was up 11%. Restaurants, used cars, which is one that's been ultra high if you go back to the pandemic from that standpoint. That has dropped year over year about 7%. Shelter continues to be a problem, but we do know the fact that rents are coming down. There's a couple different calculations that do go into rent overall, but those are here nor there for this conversation. James has a question on thoughts on Avalon Bay. Avalon Bay is a REIT that I've held for quite some time. I don't hold it recently, but it's one of the top managed REITs. One of the largest apartment REITs from that standpoint there. Wasn't a big fan of the lack of dividend growth, I should call it, from that standpoint there. Again, that's a big proponent. I'm looking less about yield and more about dividend growth. Now, again, REITs aren't going to give you a ton of dividend growth usually, unless you're talking about those rare ones that are like the PLDs, the American Towers, that have managed to grow their dividend at a 10% clip or higher on an annual basis over a 5-year period. When you look at Avalon Bay, something like 2%. I don't get excited over 2% from that standpoint there. So that's one reason I cut ties with them, about a year or so ago from that standpoint. So retiring a year with a pension. Excess cash is in 3-month T-bill ladders. And bonds is not a terrible place necessarily to hide from that standpoint there. So not something I'm all that concerned about. I don't own much in terms of fixed income overall, but also, I have a little bit ways to go towards retirement here. So that was CPI. We just looked at CPI. Not a bad report, not a great report. How about let's take a closer look at the consumer? And with the consumer here, let's look at retail sales. Retail sales came out and the advance estimate, I should say. So let's do this so we can draw on it. For April, showed no change on the month after increasing a downwardly revision of 0.6% in March. So they update once they get a little bit more in terms of information. Sales, however, were up 3% from a year ago. And if we take out auto sales, they only rose 0.2%. Now, again, in line with estimates, but that's not something that's growing all that fast from that standpoint. It seems like consumers just kind of status quo. We did get a 1.2% dip in online receipts there, as did we get a 0.9% dip in sporting goods, related stores, and things like that. So those can be thought of as a little bit more discretionary. Maybe we don't necessarily need that new soccer ball or those new cleats or those new practice clothes. We can use the old ones. We're being a little bit more conservative about how consumers spend their dollar right now. So definitely something to be concerned with right now. So that's where we're at in terms of the consumer. Let's take a look. We're starting to get some reports coming out in terms of the big hedge funds. So for those of you unaware, the hedge funds, think of Berkshire Hathaway and Warren Buffett, all of these large hedge funds have to report their portfolio 45 days after every quarter. And they usually wait till the exact last day, which is going to be May 15th. And you're going to see all the reports come out now. So these are all stocks that were held within their portfolio at the end of that quarter. Doesn't necessarily mean that they hold them today. because again, we had a 45-day window since March 31st from that standpoint. So they could have sold it April 1st, but they would have reported it on this report. So let's take a look at what Warren Buffett and company are buying. You could see that he boosted his positions in SiriusXM when he's held for a number of years there. Occidental, which is nothing new there. Closed entirely his position in HPQ. He reduced his stake in Apple and Paramount Global, as well as some SiriusXM there. So he did state that the Apple one, though, whether we believe him or not, is for tax purposes. So we'll see about that. So that's Warren Buffett. We'll cruise through some of these. So let's look at Bridgewater and Ray Dalio. What are they adding to their portfolio? We could see he added to Amazon, a stock that I recently just added to. Over 1 million shares there. How about some AMD, 680,000 shares, and some Medtronic, another one I'm looking closely at, and we might get a video on soon. What did he exit out of? He exited out of his CME Group, Discover Financial, and the other one I'm not all that familiar with, MPWR. He also boosted his holdings in NVIDIA to 705,000 shares from 268. That's a sizable boost there. Apple to 1.84 million. So he added a sizable position there, as well as Microsoft. Stakes that he trimmed during the quarter, which he's probably kicking himself now, is Cisco, because that's up, if you haven't looked, about 5% after hours. Coca-Cola, there's Costco, probably due to valuation issues from that standpoint. What else we got? How about 3G Capital? Let's look at what they're doing. So they exited out of their stake of Baba. That was probably good timing, because if you saw Alibaba, they reported and the stock fell about 7% from that standpoint. They picked up, though, 470,000 shares in Chinese EV maker Li Auto. So that's LI and Coupang. For those of you not familiar with Coupang, but I know some of you out there are. So I won't have opinion on that one. How about David Tepper? If you guys are sports fans, you know who David Tepper is. What did he add to? Fresh stakes in Adobe, JD.com. How about Boeing? Boeing undervalued right now. And on the other hand, exited positions such as FMC, Whirlpool, Mohawk, as well as General Motors, and increased positions in Alibaba, which he's probably hitting himself on, and as well as Oracle. Reduced stakes in Uber. That was good timing. Meta Platforms, potentially good timing there. Actually, that was that was good. Microsoft as well. So kind of taking off some growth aspects from that standpoint there. So interesting moves there in terms of David Tepper. And how about Tudor Investments with Paul Tudor Jones? Took a fresh equity stake in PayPal. So that's a new buy for him from that standpoint there. Exited positions in Bristol Myers, as well as the Financial Select Sector Spiders. So that's XLF, and got out of American Tower as well. So reducing his REIT exposure, increased his exposure in Abbott Labs, reduced positions in NVIDIA and Microsoft, and Visa as well. Interesting. And again, it's nothing that any of these 13F filings that come out from these hedge fund managers never weighs on what I typically do. Because again, there's that 45-day window, and most of them don't report until 45 days after, until they actually have to, meaning they could easily be in a stock. They could have shown their portfolio how they wanted it to look at that point, and they could easily have been out of it the next day. So not something I typically put a ton of weight in. Maybe Warren Buffett a little bit more, because they're known to be a little bit more in terms of buy and hold investors. Some of these other guys can be in and out on a moment's notice there. And then how about Elliott Management? Be the last one we look at here as we close in on our time here for the Dividend Power Hour. So took new positions in NVIDIA, in RIG, as well as the iShares Bitcoin Trust ETF, IBIT, 296,000 shares there. Exited out of Valeris, as well as FIS and Reservoir Media. So interesting there. Took some increased stake in Suncor, and as well as Etsy. So interesting there. Didn't see any MPW. So a lot of interesting moves there from the big dogs that kind of run the big money there. So what questions do you guys have overall? Cindy's got a question here. Does your 6-week program cover options trading? There is. So I have a 2-part option module that I go through. You could either make it part of the 6-week program, which means we're going to condense and cut out some of the normal 6-week stuff that we go through. Or what a lot of people do is we take the normal 6-week program and we add the 2-part option module on the back for a small fee from that standpoint there. It's discounted for anyone that comes through the 6-week program. So there's a couple of different routes that you can take. I also have people that come and say, hey, I've been investing for a number of years. I just want the options module. You can reach out to me as well, and we could discuss that also. So we'll be going through things such as calls and puts, things such as selling cash secured puts, selling covered calls, doing option spreads, both debit spreads and credit spreads, all the same exact way that I utilize these strategies to generate $5,000 in monthly income. That's always my goal each and every month. Sometimes I surpass it. Sometimes we come short. We're off to a good start here with our AMC trade this week. So we're off and running on that goal for this month here. But good question, Cindy. And you could use that same link down there to book a call, and we could talk more about it overall. You are welcome. Any final questions before we wrap up our Dividend Power Hour today? Again, thank you guys so much for tuning in. I always appreciate it to see some familiar faces, to see new faces, how interactive you guys are. It's always fantastic to be with you guys here. So what do we got here? Hey, Mark, do you foresee any Fed rate cuts at all this year? I'm still holding on to at least one cut right now. As you know, we've seen some poor data overall, but at the same time, if that kind of continues, it seems like interest rates are doing what they're supposed to be doing. Hopefully, we're seeing that, not hopefully, but we are seeing a weakening consumer. We're seeing slower GDP and things like that. So we're not all out of the woods yet from a recession. And when things get dire, that's also typically when the Fed cuts interest rates. So although that's going to ease pressure, that can also be a sign of things to come that, hey, the news looking forward isn't all that great from that standpoint. So I'm not going to, change direction completely based on one report that we saw last month. So I'm kind of sticking to my guns from that standpoint there. Christina, thanks for the info. Thank you for tuning in. JC, as always, thank you. Sheldon, thank you. Appreciate it. John, good to see you as always. Thanks for tuning in. Thoughts on UPS? So UPS is kind of an interesting one from that standpoint. I know I did a video on it a while back, so maybe I'll have to do a refresher. We'll look at it overall on the Investor's Edge. But if you guys recall, when I did that video, was right around the time when that new employment report was coming out, where they have to pay this extra amount, this a crazy amount higher in terms of fees based on their workforce working with the labor. Well, these unions and things like that, without to get political or anything like that, what happens is it does put a lot of pressure on companies from that standpoint. That yes, they're getting raises, but what happens in line with typically moves to, we're going to get some job cuts from that standpoint, because they're too high from that standpoint. We don't have the demand, number one, anymore. We can't have this many employees paying this type of rate from that standpoint. So what happens? We get job cuts. If they do, in fact, have to keep them, it's going to weigh on the bottom line. And investors invest not to fund companies so that they can pay employees. Investors invest to make money, to invest in profitable companies from that standpoint. So as you've seen, pretty much since we've done that video, UPS has been a one-way direction down. So they need to regroup a little bit. They need to get profits up again, stabilize things, operating income, operating margin, and figure out the right number of employees they need to have. Because at those rates, you can't be overextended. You also can't be underutilizing folks as well, and have too few of people, I should say, from that standpoint. So it's definitely a difficult spot that UPS is in right now. From a valuation perspective, you're looking at a stock that's at 18 times, historically trades closer to to 17 times. So, still slightly overvalued from that aspect, just alone. That's just one metric. I like to look at a number of different metrics, which is what we do in our 6-week course. So it's still, even though it's fallen, doesn't mean it's necessarily undervalued from that standpoint there. What else we got? Caroline, I paid for your kids' investing training and never received a link. I want the link to be able to see it with my husband. Yeah, reach out to me, Carolina Castles. Just send me an email. We'll look you up and get you that replay link there from that webinar. JC, hit that like button. Thank you. I appreciate it. Dollar cost average into Vici. I love Vici. I think there's a lot of potential. I think there's a re-rating in terms of valuation on a price to FFO multiple. What else we got? Jeffrey, don't forget to rack your weights before option trading with meme stocks. I don't typically trade while working out, but that one I had to keep a close eye on due to the craziness of the craze and roaring kitty. So awesome. Well, I think that's a great spot to end it, folks. Thank you guys again for tuning in. It's always a pleasure to come into your households and talk stocks and just get your guys' point of view. You guys can hear my point of view on where we see the economy. It is always a pleasure. I appreciate it. I wouldn't be able to do any of this without your guys' support. If you guys could kindly hit that like button down below. Also, again, join the newsletter community. We have a Discord community. That's the fastest and easiest way to get access to both me and my team and to see our entire portfolio by becoming an Edge Plus member. We have a free trial that you can just test out completely free from that aspect and check out all the great features that we have there. And if you're interested in becoming a better investor and manage your own portfolio, check out the 6-week course. Again, we have a few spots that'll be opening here this particular week, so you can get your name on the calendar. We could have a chat and see if you're a good fit for the program overall. As always, thank you guys. It's been a pleasure, and we'll see you next week. Take care.